Welcome, everybody, to our webinar today on maximizing your business value. I'm very pleased to have with us today Gord McFarlane, who is the founder and president of McFarlane Transition Advisors. And I have known Gord for, I think we're pushing 15 years now, Gord. So Gord is a very special guest here because he's got 3 decades of experience working with business owners. Of course, he runs his Heek advisory and valuation firm. And again, with that 3 decades of experience, there's a lot of lessons that have been, that he's seen, been learned by business owners. And I think he'll tell some stories today and illuminate that. So many of you on the call or who are listening to the recording will not have to learn some of those lessons the hard way. Gord is a chartered business evaluator as well, and he's served on the board there along with many other board engagements. So welcome again, Gord. Just before I hand it over to you, Gord, a quick disclaimer that anything you see and hear today is for informational purposes only, and so please do your diligence and see your own advisors before making any decisions. There's a number of new people on the webinar today, so I just wanted to take 2 minutes to just introduce myself, and then I will pass it over to Gord. And for those of you who I have not met, my name is Shamez Kassam. I'm the founder of Mount Columbia Private Wealth. I've been in this industry in various aspects for over 20 years now. I am a portfolio manager based in Calgary. Went to school in the US at Columbia University. I've done the Chartered Financial Analyst program as well. And I had a stint at Alberta Investment Management, AIMCO, a few years ago. And so my mission is really to provide business owners and professionals access to tax efficient investment portfolios and investment ideas that you will generally not find elsewhere, and at the same time covering wealth preservation strategies and estate planning strategies as well. And so you'll see I've got a picture of a toolbox on the bottom right. And the reason for that is I find many business owners are not aware of all the tools in the toolbox when it comes to wealth management. And my job is really to bring the tools to my clients, and different tools will apply in different situations. Not all tools are right for everybody. But I think there's a real lack of integrated planning and sort of tool utilization out there, and so I try to close that gap. And then on the top right, you see a picture of the book I wrote a few years ago, and it was a very painful process, and my wife banned me from writing any other books. So, but I'll see if I can break the ban. Okay, with that, Gord, I'm going to turn it over to you. Thanks again for being here.
I want to start with what I'm going to go through is a little bit of a process. As Shamez mentioned, I'm a chartered business evaluator by training. Way back when I got my CBV designation, we were doing valuations sort of independent of providing advice to the owners. Really, they needed a valuation. They were doing a tax reorganization, or they needed a valuation because they're thinking about selling, but they really didn't involve you in the process. Back then, I actually discussed with one of my colleagues the concept of a value builder program. And the concept was, boy, we're really digging deep into these companies. We're learning a lot about them. And then we're just giving them a report and a number. And thank you very much. We're off to the next engagement. And so I had this concept in the back of my mind for years, just how do you actually use the valuation process and fact-finding mission that you go through to do that to add value to the client and help them increase the value of their business over time. And so when I had retired from FYI Health Group at the end of last year, I wasn't quite ready to retire. I wanted to do some things still in the profession, and came up with, I would really like to help small business, medium-sized business entrepreneurs, helping them be successful. And that was kind of my mission. And rather than reinventing the wheel and coming up with a whole program, I found the Value Builder program already in place. And as I dove into it, it had a lot of really good tools that you can use to kind of get you in the zone and get you ready to sell your business. And so I didn't invent it. I wish I had 30 years ago when I started thinking about this. Maybe I wouldn't be working right now. But it really goes back to a fellow named John Warrilow. John wrote a book his book was really about selling your business at maximum value. He wrote a book, and there's access to the book. You can buy it on Amazon. I think we'll probably give you a link to that book after the call. But he looked at, and John was an entrepreneurial fellow. He'd bought and sold a couple of businesses, and he kind of was like me. He was thinking about what really drives the value of the business. And he came up with 8 drivers of value. And I'm not going to go through them all in excruciating detail, but what he found was there was actually 8 things that a business needed to think about when they're selling their business or getting ready to sell their business. Those 8 things are financial performance, which is obvious, and that's probably the one we focus on the most. Something called monopoly control, I'll get into that. The Switzerland structure, valuation teeter-totter, recurring revenue, growth potential, customer score, and hub and spoke. And so each of those drivers has a whole bunch of things you can be doing in your business to actually improve the performance and ultimately improve the value of your business on exit. Slide 2, Shanez. So just want to talk about monopoly control first of all. So back to slide 1. Monopoly control was really a concept that if you have a competitive advantage, Warren Buffett, the Oracle of Omaha, came up with a concept of investing in businesses that have a wide moat. And when he thinks about a wide moat, it means, think of the castle and the moat around it. It provides a defensible strategy against competitors, and it's either a premium pricing, but it's something that you have as your business, in your business, that allows you to have that competitive advantage. A little story: back in my younger days, I was working as a student through university at a trucking company in Manitoba, and we had a contract for hauling sugar beets from rural Manitoba to the factory in Winnipeg. And the owner of the company came up with a strategy to have the trucks basically come up onto a ramp, and instead of dumping the traditional way at the end of the trailer, they took the whole truck, put it on a platform, and it tipped it over, and all the sugar beets came out. And he invested a bunch of money in building that device and the whole platform and the unique trailers that went along with that, the side dumps versus an end dump. And he had a contract with Manitoba Sugar, and that contract lasted, I think, for over 30 years, hauling sugar beets. And it was so cool that I took my wife on our first date to show her that. She still laughs about that. Way to go. But that would be something like a defensible moat, something that it's going to be really hard for some competitor to come in, come up with that idea, invest in the infrastructure that was needed to get it going, and then have that contract for 30 years. So that's kind of the concept of the defensible moat. Something that's unique, provides you competitive advantage as a business person. So you might be wondering whether these factors actually work. Slide 2, the proof is in the pudding. So the Value Builder system, John Warrilow has built up a network of certified value builders, and he studied 55,000 business owners, surveyed them, and they found that the average value builder score, and we'll talk about the assessment tools at the end of this, the average score was 59. And on average, those 59 average businesses received acquisition offers of 3.5 times pre-tax profit, which is sort of a ho-hum kind of valuation, a multiple. Those that scored over 90%, 90 plus, were getting offers on average of 7.1 times pre-tax profit. So more than doubling the value of the business. So that's proven. It's been proven out through 55,000 business owners that they surveyed, and produces a very nice outcome at the end. The other thing that It's not one of the 8, but it's something to be thinking about as business owner is this concept of personal goodwill. And are you working in the business, managing every aspect of the business, or are you working on the business and, looking at it strategically and trying to make sure you're redundant as an owner over a period of time? And so that's the measure versus owner metric. Next slide. I won't go through all those in detail. I would like to get to slide 7 for this. It's the profit slide. So really, business valuation is a bit more complicated than this slide shows, but it shows the real driver of company value is in the multiple, not in profitability. Although if you can improve both, you can see the outcome. So, $800,000 business that becomes a $900,000 business at a 3.5 times multiple, is $350,000 better than just because of that profit increase at $100,000. If you actually can get your business to be attractive from a buyer's point of view and attract a 7.1 times multiple, obviously the math is very compelling. And you get a $6.3 million valuation. So drivers of company value, I'm looking at slide 8 now. The Switzerland structure is a concept that, again, John Warlow came up with. The reason he called it Switzerland structure, Switzerland is known for its independence. And so as a business owner, thinking of your business as being independent of reliance on 3 things. One would be your customer base. And so having all your customer base tied up in a few clients, obviously more risky than if it's diversified across broader client base. And I run into that fairly often in doing business valuations where client would have key customer. And in fact, to the extreme, looked at one a week ago that had 90% of their revenue came from one customer. How does that translate in a sale and the risk involved in that? Diversifying yourself across a customer base, obviously good. Doesn't have to be super broad, but certainly one customer and customer wakes up with a bad hair day, you got a problem. Similarly with reliance on a single employee, you don't want to be beholden to a single employee, because if that person decides to leave or goes to a competitor, you've got another problem. And then thirdly, a reliance on a single supplier, so that you don't have risk from a supplier going under, going bankrupt, or raising your rates, that sort of thing. So the broader you can be on the supplier side, better. It's going to go, slide 9 talks about the hub and spoke. And that's probably the most important, the 8 that I see in small businesses, especially. And this is the reliance on slide 10. This is reliance on the customer relationship. And you can see from the survey results that companies that are heavily reliant on the customer relationship, that has an average multiple of 3.76 times. If you look at folks that are really running the business, not in the detailed day-to-day of the business, their multiples were 4.5%. And that, you might think that's a bit contrary. Well, I'm the owner, I need to be knowing my customers, and I need them to know me, and they come here because of me. Well, that's great, but if you are looking to exit your business at some point in time, you really got to remove that reliance on the key customers. Something called slide 11, something called the owner's trap. And the owner's trap is, when you think about it, you can ask yourself some questions. What happens to the business if you take a vacation? Do you come back to it and you've got a million problems, or does the business run quite nicely without you? Do the customers come to you with their problems, or do they go to your team? And hopefully they go to your team. So you can spend time removing yourself from the day-to-day operations of the business. So businesses that rely on the owner obviously have less salability. And so that's always going to be a buyer's issue. Looking at a business is how that slide 12 is really talking about selling less things, selling more things to fewer customers, selling one thing to lots of customers. And that's maybe a bit extreme, but when you think of certain businesses that, they're really trying to be everything to everybody, um, the cost involved, the supply chain involvement, all those things that go along with having to, sell additional services or additional products is dramatic. And so if you can streamline that, and again, sort of going back to that defensible moat, having something that gives you a customer differentiation, a product advantage, and sell that to more customers, the better off you would be in the sale process. Something called the customer score. A lot of businesses use something called the Net Promoter Score. And if you haven't used that in your business, it'd be a really good idea to start measuring your Net Promoter Score. This is on average that have a Net Promoter Score of 8. It's a scale of 0 to 10. And those that are above 8 generally will attract a much higher multiple than ones that have a low score and are actually detractors of the business. So there's actually a measurement tool you can use to measure that and survey your customers. And it's very simple. It's really the question is that you ask of your customers is, how likely are you to refer my business to a friend? I was with a business that had exceptionally high net promoter scores, and you could see that in the revenue growth that business had. Something about growth potential. One of the other drivers, obviously, it seems pretty obvious that growth potential is obviously another factor in your business. People want to see a business that's growing. When you're looking to sell or exit your business, people aren't looking at the history. They want to look at what's the future of that business. And, history is going to tell them how you did in the past, but really what's the opportunity for that business to grow and increase in value over a period of time so that the buyer gets a return on their investment. So that's another measure of value that I think is important. The slide 15 is talking about a subscription-based model or recurring revenue model. The more you can have your business have recurring revenue, the better off you'll be. And I recently worked with a business that did industrial services monitoring services for within the business. Things had to be checked once a year. I don't want to give too much detail, but things had to be checked once a year by regulation. So they had both installation and sort of not subscription-based, but an annual inspection-based model. And the profitability of the two streams were quite dramatically different. Obviously, the inspection model, it's recurring revenue. They have to do it by regulation every year, and the profitability is very high. The business that had the installation part was less profitable and took a lot of the owner's attention to that line of business. So what they ended up doing is subcontracting the installation business to a third party and focused on the recurring revenue. So it's a dramatic shift in their business model, but allowed them to improve their margins and be much more profitable. And, we recently sold that business at a premium multiple because of that subscription-based or the recurring revenue-based model. So that's something to be thinking about as you go forward here. So just to summarize some things that you, as a business owner, you need to know. So industry and revenue are important, not the only thing. The bottom line is obviously very important, and future cash flow that's generated from the business is very important. Focusing on selling less things, make your business more simple if possible, and sell that to more people. And then there's the 3 reliance issues, Switzerland structure concept. Don't rely on a single customer, a single employee, or a single supplier. And those are really important. Try to obtain 50% plus on your net promoter score, because that will drive value, and you can actually use that in a sale process as a bragging right. Here's my net promoter score. It's above average, and that would be good from an exit point of view. Concept of leaving some field, we didn't get into that, but leaving some field left to plow, sort of the concept of look at opportunities that you haven't actually explored yet as a selling feature. And maybe you haven't explored those opportunities because you're too consumed in the business, or, you wanted to focus on certain things at a certain point in time. But if there's opportunities or there's some field left to plow, certainly those things can be valuable. Try to extract every single dollar out of the business on exit, because a buyer will really want to know that there's some upside going forward. If you can in your business, and I know every business may not be able to do this, but creating a recurring revenue stream, I think, is obviously a really, really valuable thing to do going forward.
So thank you very much for that overview. We do have some time for a conversation and some questions. I've got a few, so I will kick it off. But if there's any viewers have any questions, please put them in the chat box there. So I think you gave us some really great information, Gord. So I appreciate that useful sort of big picture framework to be thinking about. Now, in your vast experience, what are some of the key mistakes you've seen business owners make? And I'm going to preface this by saying one of the ones I've seen people make is that they don't start this process early enough. And, so 6 months before they want to retire, okay, now I'm going to sell my business, right? But that's not how it works. So maybe if you can comment on that and like any other common mistakes that our viewers should be aware of and try to avoid.
Yeah, you hit on probably the biggest one, Shamez, is that exactly that is, it's interesting. People have built and they spend so much time in their business, running their business, that they don't really think about the exit piece and how long that actually takes to really be prepared properly for that event. There's a lot that can be done to prepare. Usually, if you can start doing it today, it's great. 3 to 5 years is a beautiful timeline. Don't make it something that's an event. Make it something that's just part of normal process, and that'll take over time. There's a whole bunch of things that can be done to get your business more valuable. As the eight, there's the eight box framework that John Warlow's provided through the value builder system. There's other things, especially in certain types of industries, that you can be doing now to get ready for sale in the future. I won't go through all of them, but certainly the financials, getting your financials ready. A lot of the small business owners do their financials once a year. They don't track KPIs or key performance indicators, things like that. I recently wrote an article for the CBV Institute, Chartered Business Valuator Institute, on transferring value in a business where you think of medical practice or a professional services firm. A lot of the value and goodwill resides with the owner. And so if you can move that from the owner goodwill issue to commercial goodwill and transferring that value through having standard operating procedures, other associates in the business, having a team approach versus reliance on the doctor, and so on. And so, yeah, the longer you've got to prepare, the better. And there's a whole bunch of things that can be done to get ready for that ultimate sale. The other issue is at least 2 years, because there's some tax advantages. If you sell the shares of your corporation as an individual, there's a lifetime capital gain exemption of $1,250,000 per person. If you've got family involved in the business, you can multiply that. But it requires ensuring that your business is clean from a offside point of view. There's a 2-year look back rule where 50% of your assets have to be in the active business income, and at date of close, 90%. The 90% you can usually be figured out because you've got time to do that on closing. The 50% one is harder because you can't, if you're starting today and you've had your GICs on your balance sheet for 2 years or 3 years, and it's more than 50% of the value of your business, you've got a problem and you can't fix that. So the earlier, the better. One business we were acquiring, doctor had been very successful, used his professional corporation as his investment holding company as well. And he had his accountant on the line, and we were at a Teams call, and we talked about lifetime capital gain exemption. He had never heard of it. We said, we're prepared to buy the shares of your, you can get $1,250,000 out tax free. That was about 900 back then. He turned to his accountant and said, I assume we're okay with that. And the accountant turned white on the call, and obviously he was offside and hadn't planned for that. So that's a really good one to be thinking about.
Yeah, thanks, Gord. And then other mistakes I've seen, and some of these are not necessarily tied to the sale, but I would be remiss, I think, with this topic, not to just reiterate the importance of unanimous shareholders agreements, partnership agreements, because I have found many situations where people are in business for years and they have a verbal agreement, but it's either not documented entirely, right? Because people get busy running the business. Oh, we'll deal with that later, next year, whenever. Now the business has grown a lot suddenly, and that can be extremely challenging. Or they've got a partnership agreement, but it wasn't written properly, right? So and I have had this experience myself, right? And I'm not going to pick on lawyers, but I'll pick on lawyers, right? But I think this is true of any profession, but I'll just use lawyers as an example. There are good lawyers. There are lawyers that you would not touch with a 10-foot pole, right? And so in the partnership agreement process, you want to ensure that you're getting good advice. And, good advice costs money, but, I think it's worth it. And never make the mistake, I think also when it comes to these shareholders agreements, sometimes people try to do them collaboratively, and so they will get one lawyer to work with the entire partnership or the ownership group, and then just go through a collaborative process, but then the owners, as part of that, each waived their individual right to legal advice. I've seen that happen before, and that
Right.
can be a disaster. So make sure you get good advice for the ownership group, and get your own independent legal advice. One of the other things I've seen is that, when there are partner owners or multiple owners in a business, is there's either none, or there's not enough buy-sell insurance in the event of a death of one of the owners. So do keep that in mind as well. And if that's something that you want to discuss, feel free to reach out to me. I can also refer to lawyers that do and are quite competent on the share shareholders agreements. And then lastly, one other mistake is that I've seen people make is that they will sell their business, get the pot of gold at the end of the rainbow, big check, it's their life's work, and then they will just take it to the bank to invest it there, or they'll go to their normal, I guess, stockbroker or financial advisor. I would just caution that, when you get a big liquidity event, take some time. Don't do anything immediately, but do investigate what the options are. One of the things I'm quite vocal about is raising the bar in the wealth advisory industry, because again, there's a wide range of competency there. I think you can get into fee traps too, where you're paying too much, and there's a lot of nuances. So that's something else to consider. Now, there was one question from a viewer, Gord, and this goes to some of the comments on the growth potential. So this is the question. Presumably, a buyer will only give value to growth potential if history has shown growth. For example, growing at 20% a year for 3 years as validity to the to the future earnings of growth, 20 to 30%. scaling up. Whereas if you've had a flat revenue, even if there is growth potential, does that growth potential get discounted heavily due to lack of growth execution in the past? Does that make sense, Gord?
Yeah, totally. Yeah, it's a great question. I think obviously the business that's growing at 20% a year um, is in a market, or they have a business that um, is expanding. They're doing well. Everything's going in the right direction. It's going to attract a higher valuation than a business that's stagnant and flat, just because as long as it's profitable growth, you see the top line sometimes growing at 20%, but the bottom line not matching that. And so, I got to make sure that everything's aligning. Yeah, absolutely. A company compound annual growth of 5% versus a flat one is going to attract a better valuation. So I think the other thing is to look at the reliance issue, because small businesses that rely on a few customers, like the one I was talking about earlier, what's the contract? Maybe they're growing at 20% a year, but if it's a, 10-year contract or a 7-year contract, and then it's got to be renewed and go to bid again, potentially, what's that worth? So in situations like that, there's more risk, obviously, to that growth curve. So you really got to drill down and into the numbers and see what's driving that growth. The other thing would be the buyer. Sometimes the buyer is in an industry where perhaps that business isn't growing, but they're growing both through organic growth and potentially through that acquisition model that's providing inorganic growth. Like we were at FYI Health Group, sometimes we would buy practices that were flat with revenue growth, but we wanted to be in that market because we felt we could bring to the table additional factors to raise that growth. So has to really, drill down and look at both sides of the equation.
Thanks, Gord. So, two last questions before we wrap up, right? The first one is we always hear about, just based on pure demographics, there's going to be a wave of business succession needed in the next few years. And there's going to be a wave of businesses that are going to need to be sold. And so this is sort of digging into Gord's crystal ball here, right? But do you see, from your chair in the next 10 years, 15 years, there's going to be a lot more supply of businesses needing to be sold? And could that supply pressure valuations in general somewhat? I know that's a tough question, but while I've got you, I think it was one that was on my mind anyway.
It's a good question. There's certainly lots of data that's saying there's going to be a succession tsunami, that there's been articles written about it, etc. If they all hit the market at once, it's like, everybody's selling their condos in the Okanagan all at the same time because of the speculation tax. Personal situation. If they all hit the market at the same time, then yeah. And if they're all sort of plain vanilla, then yeah, multiples will go down. But if you've got a special niche, or you've got a business that's outstanding in that marketplace, then you're gonna maintain your multiple. I would think. The other thing is having a strong advisor on your side when it is time to exit, creating an auction process. So it's not just somebody knocked on my door, they want to buy my business. There's lots of those people out there. And actually the one we just closed the end of January, it was that situation. They were getting knocks on the door by people, and they decided that they should actually explore a sale. So we ran, rather than just going with the guy that knocked on the door, we ran a process and we had an auction basically.
Yeah, I think that's a really good segue, Gordon, because I think, one of the other things I've observed too is that, and again, this depends on the size of the business and the and the business owner largely. But I think sometimes, even with small to, even medium-sized businesses, because the business owners can struggle sometimes as to where to get the right advice. Speaking of mistakes, I've seen some business owners just, look up a business broker either online. I was going to say in the yellow pages, but those don't exist in that format anymore. But looking up a business broker and assuming one business broker or one valuator is the same as another. And And so I think business owners can sometimes make mistakes and not get the right level of advice too. And again, it depends, like, is this a one Subway location or is it larger than that? But just a point I wanted to mention, because I think it is really important having the right people on your team as a business owner. And so with that, Gord, can you talk about the way you work with clients and then also what your process is and some of the tools that we'll be sending out and what those are and sort of how people should use them? And then we'll wrap up. Thanks.
Yeah. So there's three tools that are on our website. They're free. You can do them yourselves. One is it's called the pre-score. So your personal readiness to exit. And that's really, it's a little bit soft stuff that, what are you going to do in retirement? What do you want to do in retirement? Are you ready to retire? Do you have hobbies? You're sort of living your business day in and day out for the last 20 years. Have you really thought through what you're going to do? And so it really kind of gets that personal readiness assessment. You get, it's a 20-page report, and it allows you to sit down with your family, your spouse, and kind of talk through some of those things. Because I've seen businesses where a husband's ready to sell, and all of a sudden he sold the business and says, "Hey, honey, we're going to the Bahamas for a year or whatever." She said, "Well, no, I want to look after the granddaughter." That's it's a tool to kind of get you thinking about, is this even something you want to entertain as an exit? There's another one that is, well, how much do you need? And this, Shemez, this is where you can come in. It gets you, to a number. How much do I need to retire? It's a little bit simplistic, to be honest, but it gets you thinking about it at least. And then, turning to someone like yourself, here's the actual math. Here's what you really need to be thinking about, helping with the financial planning side of that. And then there's the value builder tool itself, which is more detailed. It goes through the 8 value building blocks to increase the value of your business. And that you can do as well on the website. And that gives you another report. I prefer not to harass people and get too detailed in the discussion until they've kind of done those tools, because I think it's allows them to kind of think through things. If they need some help filling them out or they have some questions, I'm happy to do that for no charge. Get them, really just trying to help them provide a service to get them thinking about the exit. Back to your point about doing it early versus the day before that they want to sell. And so that's kind of the process. And sometimes it leads to a business valuation, like a formal business valuation under the Charter Business Valuator standards, which is a very, you can go to even the value builder exercise as well. Your business is worth 3 times. Oops.
Yeah, are you still there, Gord?
Yeah, I just lost my screen.
Okay, that's okay. We can still see and hear you, so you're good. Yeah.
Okay. Sorry about that.
No, it's okay. Yeah. So thank you very much for all of the information and sharing your insights here. I think, last point I'll make again, a couple points. One is a word of caution. When you have a multiple owners in a business, again, going back to that shareholders agreement, all of the valuation methodologies and the process should be in there, and it should be written properly, and it should be airtight such that if the ownership group has agreed to a valuation process, then it needs to be ironclad so that process cannot be challenged. I have seen situations where there is vague or general language about this is the process. The company will pay for one valuation. If either party does not like that number, they can go and get another valuation, and get that completed at their own expense, and then you take an average of the two midpoints. Sounds easy, but if it's not worded properly, then that clause can be legally challenged, right? So again, you want to have a good lawyer. They're expensive, but get the right people in your corner from day one. And on the exit valuation, or the exit planning and the valuation side, of course, you've got Gord as a resource here. And so we will be sending out an email in the coming days with the recording, a link to those tools and the slides. And so feel free to reach out if we can be of assistance. But I hope you found this session informative, and there's some good things to take away. And I wish you all the best, and we'll see you next time. Thanks very much, Gord, again, for sharing
Thank you.
your expertise today. Thanks so much.
Thank you.
All the best.